Trade war makes a dramatic headline, replete with dire implication. Donald Trump's bellicose trade rhetoric has destabilized financial markets. Foreign investors are retreating from emerging markets. The Chinese stock market is down 25% since January. But how much harm will the U.S. president's tariffs actually do? Trade experts have joined the chorus of concerns. Economists are renowned for their diverse opinions, but they are unanimous on one topic: trade restrictions are bad. Trump is ignoring the wisdom established by English economist David Ricardo 2 centuries ago: a country cannot make itself better off by imposing trade barriers. To do so is like putting rocks in your own harbors. Trade should be multilateral. Countries should buy from the cheapest supplier and sell to the highest bidder. Trump is busy recasting trade in bilateral terms, and promoting America first, perhaps exaggerating the damage might be justified if it pushes policy in the right direction. But proper analysis of trade distortions needs detailed model-based calculation. For the DU merchants, the inconvenient truth is that the effect of Trump's announced measures is quite small. Trump has imposed restrictions on steel and aluminum imports, with some suppliers exempt, and a 25% tariff on $50 billion of Chinese imports, extending over time to a further $200 billion of Chinese imports. These measures won't have much impact on U.S. imports as they are not imposed on all suppliers. For imports, the loss to Americans is just the difference between China's supply price and the somewhat higher supply price of alternative sources, domestic or foreign. Moreover, being a large resource-rich country, America's international trade is relatively small. Imports are 15% of gross domestic product, around half the OECD average. With U.S. GDP around $20 trillion, the likely loss is small. On the export side, China's retaliation just means that American soybeans go elsewhere in global markets, and China buys from somebody else. What do the detailed model-based calculations say? The International Monetary Fund's World Economic Outlook, prepared for the annual meeting in Bali earlier in the month, presents a variety of scenarios, with a base case scenario incorporating measures which have been already announced. This scenario assumes tit-for-tat retaliation by other countries, plus a hit to confidence which reduces investment. In this scenario, the longer-term loss to American and Chinese GDP is less than 0.5%, the blue lines in the graph below. For the world as a whole, the impact hardly registers. The fund describes these effects as small but perceptible. Perhaps they should have said barely perceptible. The fund explores additional restrictions. But even its worst-case scenario takes less than 1% off U.S. GDP, 0.6% off Chinese GDP, and 0.1% off the world. In any case, these scenarios are hypothetical. For example, they assume that NAFTA collapses, which now seems overtaken by the replacement of NAFTA by USMAC, the United States-Mexico-Canada Agreement. Most of the predicted disruption results from restrictions on automobile trade, still just a threat. The scenarios also assume a quite limited capacity to offset the shocks with policy measures. Trump has already announced subsidies to soften the impact on American agriculture. The Chinese are contemplating similar offsets. The damage of these worst-case scenarios is not trivial, but is still pretty small. Far more damage was done in the 2008 global financial crisis and by the misguided budget austerity during the recovery. As a result, U.S. GDP is more than 10% lower than it was predicted to be in pre-crisis projections. Trump is probably doing more harm to the global economy through his company tax cuts. Thanks to this ill-timed fiscal expansion, the U.S. economy is growing at an unsustainable pace. Instead of gently nursing the mature cycle with the aim of sustaining it for some years, Trump has administered the sugar high of tax cuts which will bring an earlier downturn. This has left the U.S. economy out of cycle with the rest of the world. The strong dollar and rising U.S. interest rates create the tensions currently seen in emerging markets, where even well-run economies such as Indonesia have to tighten fiscal and monetary policy to cope with the foreign capital reflow to the U.S., with adverse impact on growth. To downplay the importance of Trump's tariffs is not to deny the broader, but much less likely, threat to globalization more generally. The spectacular post-World War II rise in living standards in both the developed and the emerging world owes much to this era of increasing globalization. International openness created a powerful dynamic, with exchanges of ideas and production techniques, rising education levels, foreign investment, and competition which forced efficiencies on previously inward-looking economies. All this took place within a trading framework that was full of restrictions, exceptions, inconsistencies and misconceptions. Despite the imperfections, globalization expanded. This is a robust environment, not easily disrupted. Trump's misguided tariffs and withdrawal from some international cooperation, such as the Paris Climate Accord, are unhelpful, but so far marginal. America first does not imply a hermit kingdom. Trump prefers bilateral trade deals to multilateral, but he still wants trade, not autarky. The author of The Art of the Deal wants to win the negotiation, not walk away, as the NAFTA replacement pact shows. He wants international agencies to favor America, but he is not abandoning them wholesale. Meanwhile, other countries can, and should, keep the momentum of cooperation going. They can offset their U.S.-related losses through further trade opening among themselves via multilateral free trade agreements such as the 11-member Comprehensive and Progressive Trans-Pacific Partnership, which has replaced the failed Trans-Pacific Partnership, and the Regional Comprehensive Economic Partnership. Globalization is deeply embedded not just in established production facilities and supply chains, but in mindsets as well. It seems unlikely that Trump's trade policies, while misguided and self-harming, mark the end of globalization. Stephen Grenville is a non-resident fellow at the Lowy Institute in Sydney. He was deputy governor at the Reserve Bank of Australia.